Hey everyone, welcome back to the Mike Rosehart Show. We're live again for another Wednesday installment, and today I am feeling like shit. 1 o'clock today, 2 o'clock today, NASDAQ's down 1.3%. I'm looking at my short and I'm like, shit, I'm up like 100 grand. I should just close this out. And I'm like, you know what? I'm not gonna close it out. I'm gonna leave it on. I think Nvidia's gonna shit the bed. And I'm like, you know what? I was talking to a few friends. I'm like, Nvidia's just so overvalued. And we're looking at it, we're like, 100 PE ratio. Like it's trading at 100 years of current earnings. 100 years to make your money back. That's craziness. Like there's no way that it grows that fast and no competitors come in and eat their lunch. And like when you think through, like when you buy a graphics card for a data center or a computer, you're good for a couple of years. If another model comes out next quarter, you don't buy another one. You're good for like 2-3 years. The incremental improvements are not that large between the cards. I'm like, there's a huge growth spike because AI is happening, right? So like revenue's gonna shoot, but like it's gonna start plateauing, and it is plateauing towards a much, much slower growth rate. And I'm like, well, as soon as that happens, I mean, the P ratio is going to fall from like 90 to 100 down to like 25. So it's like, it's way overpriced. No way it's $1 trillion company. No way it's more valuable than the entire Chinese stock market. What the fuck? Like, makes no sense. So I shorted Nvidia too. And Nvidia's up 8%, 8.5% after hours. And immediately it went down like 4 or 5%, which is the correct reaction because a beat of 25% was already priced in. But for some reason, they beat by like 10 or 15%. Not even that much. They always beat. Analysts are always super conservative and they always over deliver for Nvidia. But anyway, already priced in and the market's just going euphoric. I look on the boards because I'm curious to see what the investors are thinking. And it's all just dumb GameStop money. Like, to the moon, 1,200 a share, 10,000 a share, tomorrow up 50%. It's like, there's no basis in reality. All these people are just crazy. Like complete dumb money. And I'm like, wow, that's who I'm betting against. And that's who's taking my money. That feels bad. Yeah, had a tough day in real estate today too. Had a bunch of problems at all the properties. Problems in Florida today. We had problems here in Canada today. One of our sales is falling through as well. Just so many challenges in real estate. And then to get the icing on the cake of, I lost $100,000 in about 15, 20 minutes on the Nvidia earnings. It dragged the entire NASDAQ down 1%. I mean, from when I had my short on at 2 o'clock till now, I think the NASDAQ was negative 1.3%, and it's now in after hours over 1%. So that's I guess it reversed to like a 0.4 on close. So it lost 1% in the afternoon and then another percent after hours. So it's 2% almost that the entire NASDAQ moved. And then I also had a huge short position on Nvidia. So that'll be shit on tomorrow. I'll lose like, I don't know, 20 or 30 grand, I'm sure, on that Nvidia short, which eventually will pay off if I can have the staying power. That's the hard part, is like watching, your position get eviscerated and holding on in either direction. Even just holding the index, it's hard to do. When you're holding like the S&P 500 and you watch it, like in January 2022, I loaded in $5 million in the NASDAQ and in the S&P 500. And the market subsequently, I think within a quarter, everything that happened with Russia and they went to war and all the stuff that happened in 2022, I lost a quarter of my entire portfolio. I was passively holding the index, and I lost a quarter, which in my case was $1 million in about 4 months. Just the passive strategy. When I should, I just held it and not touched it. But instead I switched to shorting and started trading and stuff. Because I'm like, this buy and hold thing isn't working for me. And I needed more, and that was stupid. In hindsight, very stupid. The learning outcome here, the lesson for you guys is, don't do as I say, or don't do as I do as I say, right? So like, as an example, I have a dividend portfolio that I rarely touch. That's been sitting for years. That's a smart portfolio. That portfolio, although the dividend portfolio, if you look at dividend stocks in Canada, the bank stocks like Bank of Nova Scotia and the big 5 banks have really not, they've really not performed that well. Bank of Nova Scotia is down like 19% on the 1 year. Your stable financials in Canada haven't done that well. I would say it's one of those things where I would say, when you're trying to build a good portfolio, the most important piece is never put everything in one, obviously all your eggs in one basket, right? So the learning outcome here is like, and thankfully I did that, right? Like I think my trading accounts maybe 7% of my entire net worth. And so this, like as an example, the Nvidia short that I have on is less than 1/200th of my entire net worth. So it's literally nothing, which is important. Like if you're playing around with this stuff, it needs to be not important, right? You can't be putting your entire net worth into crypto or your entire net worth into stock trading or even your entire net worth into real estate. I mean, I think it's important to have some diversity in all that you do, right? It's important, I think, to be able to have, some play money. And I think that some people, like myself included, I like to have something that I take some risk with. And I think some people out there like to take a certain amount of risk, and it's important to not obviously bet the house, right? Like never bet the house, never bet your main source of financial independence. But it's important, I think, to have those things kind of planned out ahead of time, especially like having a plan is so important, because if you don't plan, there's a saying, right? Those that plan to fail, or those that fail to plan to fail, right? So if you don't have a plan going in and you're just winging it in life, you're going to fail. I mean, you're going to be way less successful than you otherwise could have been, right? Just in general, is like a comment that I've noticed as my net worth has grown, right, into the 8 figures. It's crazy because like if you're an 8-figure investor, and I've bounced in and out of 8 figures and flirted with it, and I with leverage I had a portfolio of 25 million in real estate at one point, right? And this is in 2020, and like it's crazy because we watched the real estate market here. Like even real estate is a stable, secure asset, right? And like real estate in Toronto and in London, it moved 25% down in a single year, right? And most people put 25% down. That's 100% loss. That's like buying a stock and it goes completely to zero, gone, wiped out. That's real estate for you, right? That's risk inherent with that, right? And so that's why you don't want to pull all your eggs in one basket. But the point I'm trying to make is that like that kind of stuff can happen. And you need to have a plan to prepare for that. And some people didn't. They went all in and they levered up to their tits. And it's, you got to be careful because the tide went out now. And in real estate, specifically in Ontario, you're seeing people in Toronto. I know lots of people in Toronto, in London here, in some of the tertiary markets, the smaller towns that lost some demand too during this kind of pullback we've been in. Like real estate prices in the spring of 2022 to now have fallen almost a quarter. So if you had $1 million house, it's worth $750 now, give or take. That's 2 years of holding it, and you've lost 25% in value. Your appreciation is negative 25% over 2 years. And a lot of these people are running models where they're expecting a 5%, 7% appreciation. So they were expecting to be plus 7%, plus 7%. Now we're going into the third year, plus 7%. Instead, what happened is they lost 25%, a little bounce, and then lost more. And it's like way off from their expectations by some cases, 30, 40%, right? And it's interesting, I think, just in general, when I think back to like investing philosophy, whenever I try to invest in a property, I look back to what the cash flow is. And the reason I buy stuff that produces strong cash flow is so if price moves in a crazy direction up or crazy direction down, I mean, you're not affected. You can hold it for 10 years. And over the long term, assets always appreciate in value, right? Which is why shorting is dangerous. It's why you want to hold assets and you want to have leverage attached to assets, but you want those assets to be able to produce cash flow to sustain the debt, right? Really, really important that it can service its own debt. You don't have to service it. You want to be the one that's just collecting what's excess, what's left over. And all the tenants or the business profit can cover those expenses. Let's go to the Q&A for a sec here. David says, hello again from Alberta. Could you please explain your new subscription on Instagram? Should I unsubscribe it from YouTube? David, really, honestly, it was just something that I wanted to try out. So I just made a little subscription thing. It's just going to be a place where I can post a few stories and stuff like that. It's a place where you can go and support. If you're supporting here, you don't have to support there. You could support there instead if you'd like. It doesn't make a difference to me. Both are okay. Both are much, much appreciated. It also lets the algorithms know that there's value in the content that I'm producing. Both Instagram and YouTube are businesses, and they're going to reward creators who have a following and who bring them money. So that's why I turned on the subscriber feature. Yeah. Gurinder says, hi, Mike, hope all is well. How do you think housing will do in the summer going into the fall? Well, historically speaking, in the, I guess, like May, June timeframe, real estate peaks, specifically in Ontario. In places like Florida, it peaks now until, May or so. But the spring typically is the peak time, especially in markets that are cold because landscaping doesn't look good in the winter. House price from December typically to May has a seasonal adjustment of 12% on average over the last 25 years here in Ontario. In London, in Kitchener-Waterloo, in that this whole area is where I kind of looked at the data. And I assume it's the same in Toronto and other markets. From what I've seen, there is a seasonal adjustment that exists. So you don't want to buy in the spring. You want to sell in the spring. You want to buy in the dead of winter, or you can buy in this, there's a summer slowdown typically you can buy. But the thing is, people don't want to move in the winter. And people don't want to move during school years. So they wait till the kids get out. They buy a house in May that closes in the summer when the kids are off school. That's typically when people move. So just in general, people don't want to move in the winter. There's a discount that's associated with selling a house, or a discount you get if you buy in the winter. So to answer your question, the best time to sell is the spring. That said, there could still be opportunities. A lot more volume happens in the spring. So the number of houses that actually sell, that actually come up to list, increases exponentially in the spring. I think it's like 4 to 1 compared to like December. So you'll see 400% more inventory, which means the house, if you're looking for a really unique property, that unique property is probably not going to come for sale until the spring, when there's a volley of new listings that pop up. So I'm not saying you can't buy in the spring. There's deals all year round, but you'll get more deals and better deals, I guess, in the off-peak times. You can negotiate harder and get better prices. Okay. David says something about degenerate or something. Totally true. I mean, to be fair, like picking out stock trades and trying to bet on individual companies, and whether you're going long. Honestly, there's more risk going long Nvidia right now, to be honest. You go and buy shares in Nvidia, there is more risk of downside than shorting Nvidia. That's data. I believe that's data supported the next 5 years. There's probably a better chance of losing money in the next 1 year to 2 years if you buy Nvidia shares right now. That's why diversity is so important. You don't want to buy one company. You want to buy the collection of the entire index, right? If you own a little piece of everything, you can't lose. You do not want to short individual names for very long periods of time. You want to, if you're going to short for a small amount of time. And if you're going to do it with a very small amount of money. Like I guess I threw out there that I lost 30,000 or 50,000. 30,000 or 50,000 has wiped my ass money. I literally wiped my fucking ass with it. Light it on fire on a podcast. Doesn't even matter. Like, it's so little to me. I make that in a week, right? Like that, my real estate portfolio, my lending portfolios, it all produces tons of income. So for me, it's all to scale, right? But yes, I would say that stock trading and picking individual stocks in general tends to have a fair bit of risk with it. There is a high risk profile associated with doing that. The majority of stock traders don't beat the S&P 500 net of time, or net of fees. And then when you factor in time, it's even worse. Like my time's worth at least $1,000 an hour. So if I spent 3 hours today, stock trading a little bit, reading articles about it, that's $3,000, $4,000 of my time. If I do that every day, we're talking about $500,000 to $1 million just in my time that I've spent. That's opportunity cost of my time, plus whatever I lose or make. But opportunity cost of stock trading is very high. The clear answer is I need to close my account. I've set a target for myself of 1 down month. The NASDAQ goes down for 1 full month. We had that opportunity in October. I didn't take it. I didn't exit. I did close the short, but I put it back on. This time I've decided that 1 month, I'm done. I made the agreement with myself. So far we've been waiting. We had a good start to January. First few days it was down, and then it rallied like crazy all January. And then February's just been rallying some more. So the NASDAQ has continued to chug along up almost continuously since October 26th. We've had no full down week yet. Yeah, I can't think of any 10-day period where we've been down. Maybe if you cherry pick the data, but over a month, certainly not. So if we have 1 down month, which we will have this year, even in the hottest raging bull markets, there is an August 2023, there's an October 2023. In the hottest and bullish markets, you get down pullbacks, right? So I'm just waiting for a pullback. I'll exit the position. I've already downsized my short position 50%. So what I was trading with last year, I have 50% in that account. So I've been pulling money out of it. I'm slowly dwindling it down. So there's less and less opportunity for loss, so to speak. And I've compartmentalized it to less than 10% of my net worth. So it's in a position where, like, even if I lost it all, it doesn't matter. It's play money. That helps me, I think, and also hurts me in some ways because my mind is like, it's just play money. It doesn't matter. So I take exorbitant amounts of risk because, again, $30,000 or $50,000 doesn't move the needle for me. But if I can make $200,000 on a play, that's exciting. That's something that's like worth my time. But again, hard to beat the market. I'm not saying that I can. People get lucky, and if they do get lucky, they should quit. So if I do eventually get lucky, it's like I've been flipping a coin toss, and it's like it's not like a coin toss because in a coin toss, each time you flip the coin, it's an independent trial. So the previous toss has no direct causation on the next toss. They are not related. However, in the stock market, if it rallies and rallies and rallies and prices get, way out of whack compared to cash flow and income statements, you're looking at the cash flow or the cash flow statements, or looking at the assets, the net asset value of the companies, the earnings power value. You can look at like fundamentals of the companies. You can actually determine whether or not something's trading overvalued or not. Previous days do predict whether or not something is going to influence the next day. So historical data is important in the stock market. When you're flipping a coin, it isn't. But like flipping a coin, I have bet on certain events like NVIDIA earnings, as an example. It was a coin toss. Who knew how it was going to go? That was a coin toss. And that's an example of like, how unlucky can you be for how long? I will be a net loser, I think, on my stock trading in the last 2 years. Because again, I chose the bear position through the biggest bull run since the dot-com. We're reliving the dot-com bubble right now in tech with AI. It's the AI bubble. And people think that there's a lot more efficiency and profit can be driven by AI quicker than it actually will be delivered. So I love AI, and I think that's not true. I actually have my reserves, my fears related to where I think AI is going to take humanity in general. There's some dystopian realities we can think through that are, there's some really scary shit out there that, a select few people could decide to do horrible things with AI. And it would be such that humanity can't really stop it. And a few individuals could really wreak a lot of havoc. But let's not go down that road, because that's a dystopian reality I don't want to chase in this stream. But in the short term, it can deliver efficiencies for companies. I just think that some companies like NVIDIA and some of the Magnificent Seven are worth more than the collective emerging market economies like India, China. They're saying it's worth more than the entire economy of China, 1 billion people. What? A tech company is worth more than the entirety of 1 billion? No, I think they're a little overvalued. In my opinion, a little bit overvalued. Maybe they'll grow into that valuation, but they're not there yet. And I don't like to pay for what hasn't happened. Like, if you were selling me a property, you're like, hey, I'm going to get rent for the next 10 years. Like, do you want to pay me like for the next 10 years of rent? I'd be like, no, I'll pay you for what it's currently producing in rent and a multiple of such. But what if the tenant leaves? What if you have a commercial tenant and they leave in 2 years? What if a competitor comes in next door and builds a different building and then your building's vacant? Like, shit can happen. My point is, NVIDIA could have competitors come in and take them out to just destroy them, right? Create a better product. And so when you price in that kind of growth for a 5 or 10 year period and you use forward-looking PE to judge your valuation of the company, there's a lot of risk inherent with that, because achieving those said targets is difficult. And that's my word of caution. I'd say if you love tech, there are tech plays you could get into. It's very overvalued right now. There might be an opportunity. Like if we saw a big pullback in tech, you'd probably see me invest in NVIDIA. If we saw NVIDIA at $200 a share, at their current financials, $200-$300 a share, I'd be buying. You see Tesla at $70 a share, I might buy shares. But Meta in December 2022, go back to my live streams, watch them both. I was screaming from the rooftop. Meta was a 9 PE ratio. It was $90 a share. I bought $600,000 in shares in Meta. I loved the company. I held them till $140 a share. That's when they started to get overvalued to me based on they obviously did better than I expected they would do, but based on what they're delivering currently in cash flow, they were buy opportunities. So was Intel. There was a great buy at $25 a share back in December 2022. If we get another pullback, I'm not anti-tech. I'm shorting the NASDAQ. It's overvalued. It may grow into the valuations that currently exist, but they haven't yet. And that's why I'm shorting. It's an investment in reality. It's an investment in fundamentals, in cash flow statements, in the value of the company's actual assets. I consider it an investment. And so when we see things correct to reality, I'll probably switch from short to long on some of these tech names. But I'm waiting for that opportunity to do that. So anyway, that's my current position. Vena Fitness Studio might have binging old videos. Have you gone back and watched them? No, I try not to watch my old stuff. I don't really like to watch, it's crazy to watch my mindset over then too. Like if you go back and watch some of my videos from 5 or 6 years ago, I was a kid, like a 24-year-old kid making videos, 25-year-old kid. I had, I didn't even have 3 kids yet. My mindset was totally different than where it is now. And I've gotten a lot wealthier to the point where like I'm still frugal like I was, but when you make 100 grand a year and you spend 30 grand a year, you're spending 30%, you're saving 70%. 30 grand a year is a pretty frugal existence. And so if you grow your income from 100 grand a year in passive income to $1 million a year in passive income, all of a sudden, if you spend still the same expense ratio, you're saving 70% of what you earn, I have to spend 300 grand a year to maintain a 30% spend ratio of what I earn in passive income. So it's like, I just started making way more, and it's hard to be true to my frugal. Like I watched some of my frugal videos I used to make, and I still believe it's true. I think at the end of the day, when you run a business, you should run your personal life like a business. So all the fundamental, truths that I was speaking then, or lessons that I was speaking then, are true. I've just scaled them differently. Now, like back then, my time is worth $20 or $30 an hour. Today, my time is worth $1,000 an hour. So standing in line to save $50 on groceries, not worth it like it was before. I used to be able to do it, and it would be a good use of my time. It's just not anymore. My time has gotten more valuable and more scarce as I've gotten older. I just turned 31. I'm an old dog now, right? I'm in my 30s technically now, and it's like I've had a perspective change over time, and I think that I definitely value time with family more than, and even time, doing things I enjoy more than I did then. I would put myself through more hardship, than I do now. In different ways, though. I mean, in a lot of ways, I'm still the same. I'm still the same person that I was then. In a lot of ways, I probably work just as hard now as I did then. I haven't slowed down. I thought I would. I thought I would get like a certain net worth level, certain Lux fire, and I would just like chill on a beach. Just hasn't happened. I continue just to take on bigger deals and bigger challenges. I need something to stimulate myself. I think, like I grew up in a foster home, and I moved 19 times. I went to a bunch of different schools. I had a fucked up childhood, a fucked up life. Admittedly, like lived with a drug dealer for a while. My mom's bipolar, and I was a hoarder. And I had a whole bunch of family issues, right? Growing up, and I'm fucked up because of it. Like no doubt, it's part of why I've succeeded. Is that fear of poverty and escaping what I grew up in. But at the same time, I think I thrive in conflict. Like that's my homeostasis, was like hearing people fighting in the background as a kid growing up. And so I think that's why I gravitate to business, because there's so much challenge and hardship. And maybe that's in the stock trading why I do what I do. Like I'll take on these crazy trades that give me insane stress, or I'll take on these, these hard properties that need stabilization. And I think part of that stems back psychologically to my fucked up childhood. And I crave that. Like I didn't grow up in I was always in a single parent household. I moved around a ton. I had like 6 different parents as a kid, right? At different times throughout my life. And it's like, I think that's, when I go back and watch those videos of myself then to now, and I watch my progression, and I notice that I tend to seek out struggle. I tend to seek out hard. And maybe that's because of what I grew up with as a child, right? I believe that I deserve that struggle. And thankfully, I'm a very hardworking individual who doesn't back down from a challenge, right? I just push through. And in certain things, that's a great blessing. Like in real estate, if I run into a tough struggle, I work harder, the project succeeds because of my hard work. In the stock market, if I increase, my position, what ends up happening is I close the door, please, sweetie. I'll be out there in a minute. Thanks, sweetie. One of my kids just came in and wants me to come up to bed, and I'll be there as soon as I can. But lost my train of thought here. What was I saying? Oh, I was talking about childhood and talking about how it comes back to the stock market, right? And I think a lot of it comes back to our personalities coming into our trading philosophies. And in the trading world, your time investment doesn't necessarily, the more time you spend doesn't necessarily equate to a better result. You can spend so many hours researching and so many hours reading reports, and then the market can just decide that like GameStop. Look at that show Dumb Money. It's a great movie that just came out. I just recently watched. And with GameStop, right? It's like, it didn't matter about fundamentals. The current company was garbage. It is garbage. And it was like trading at 400, crazy ratios, crazy ratios. So, Vern says, greed is slowly declining on the fear greed index. Do you reckon we continue seeing pain as we see no rate cuts? Well, Vern, I think that you're right. Greed is declining, especially in this last week. We've seen quite a pullback. Like, I think the NASDAQ tried 439, 440 price target and then retraced back, right? We were in the 423 range, 422 range today. Now tomorrow it's going to open like 429, 430 because NVIDIA is literally carrying the whole market. NVIDIA alone is going to carry the entire index up over 1%. So that's wild. Randy says, you spoke about dividend portfolios. What percentage should this return? Capital appreciation heavy portfolios to regularly cash out to recognize gains. So Varun, talking about stock portfolios, the reason that the dividend portfolios aren't producing a lot right now, they are producing a dividend still, but they're not producing a great yield, is because all of the capital flew out of dividend type stock, financials, etc. And there's also other things going on. Like when interest rates rise like this, people tend to be afraid to be in banks because banks are heavily sensitive to rising rates. It causes a lot of pain for their balance sheets, right? Also causes risk for all the lending notes that they have. So there's a bunch of reasons why dividend stocks haven't done well. One is high interest rates. And again, people just flee to where the best yield is. If you can get a risk-free 5% in a money market fund or even 6% in a money market fund or a treasury bill right now, why would you take a risk on a 7% dividend stock that's been going down? It's like you can get a risk-free at 6%. So there's a big, I think, disconnect between the value in dividend stocks and right now specifically. So that's been a challenge, I think. Might be a buying opportunity. If rates do fall back down to 2 or 3%, real estate would do really well. Real estate's not doing very well right now. And then the other thing would be like dividend stocks would do really, really well. People will flee back to their 7% yield when you go and get 2% elsewhere, you might park in dividend stuff. So utilities, financials, stuff that pays really heavy cash flow dividends. But yeah, talking about how you handle your portfolio, it depends. Typically what you do is you look at your portfolio. If you're heavy in any one sector or position because of crazy appreciation or depreciation, you'd rebalance your portfolio once or twice a year. That if you're heavy in one sector, you'd sell some of those shares, use that capital to rebalance into other asset classes within that stock portfolio. So that's typically what you do. Do you regularly cash out? And I don't. I don't need the money to live on, but if you did, then maybe you could. I leave it inside of a corporation and let it ride. In this case, the losses are kind of nice too in the corporation because I can use those as deductions and carry forwards in the future. So Johnny says, hey, Mike. Hey, how you doing? Raz says, is Airbnb a piece of the house or a whole house is still legal within Ontario? So Raz, my understanding is it depends on the municipality. It's not Ontario-wide, it's municipal. Toronto, I think it's illegal. London now has new rules that make it illegal to Airbnb your house. But if you live there, then you're allowed to Airbnb your house while you're traveling or if you're gone for a few months. There are restrictions on your primary residence. If you have a second unit, I've heard it's okay if you're occupying. So it's more like they're going after the commercialization of it. Most of that was lobbied by the motels and hotels and the Marriotts of the world. And also they're blaming the housing crisis on Airbnb, which again makes no sense. Supply side issues are the reason we have a housing crisis right now. Tenzin says, how do I get rich if I only make 70,000? Well, you'd have to start investing. 70,000 is a ton. If you invest that over a long period of time, what you'll find is that those gains become astronomical, right? Like if you took even half of that income, if you learn to live on $3,000 a month and you put the other $3,000 a month on your 70,000 salary into, a balanced, portfolio over 25 years, you're talking about accumulating $5-10 million with compound interest. So you run it through a compound interest calculator. I don't have it available to me, depending on how long the time horizon is, what your current age is. If you're doing that in your 20s, by the time you're in your 60s, you've amassed a huge amount of money. On 70 grand a year, if you could learn to save half and live on half, if you needed $3,000 a month to live at 50% savings rate, 12 years, you could replace the income completely with passive income. If my math is around that, I think it's 12 years. If you do it with real estate, you could do it in 6 years, depending what growth rate you use for compounding. I use real estate as an example because leverage allows you to obtain, if you're putting 30% down, the bank puts the other 70%, you're a little over you're basically 1 to 3, right? Ratio. They're putting 2/3 of the money, you're paying 1/3, a little bit less than 1/3, but you get the idea. So if the property can produce a 10 cap, maybe if debt's cheap enough, you could sustain a 20% CAGR. Now that might, compounding annual growth rate is CAGR. Now that might be requiring you to do a little bit of work. You might have to manage the property. There'll be some bookkeeping involved. There'll be some maybe tenant concerns and issues. You might have to renovate the property after a few years. So there's some energy that goes into maintaining that 25% yield, but that allows you to scale and build up a nice, sizable level of wealth. No, David, I wasn't saying you. It's someone else. There was another David that left a comment that got blocked about the NVIDIA trade that I made. Alex says, as a first-time multifamily buyer, would you be the sweet spot to start, in your opinion? Or which would be the sweet spot? Looking at current market. So again, there's no it's hard to make definitive rules, right? Like in some areas, you've got, like in Alberta, as an example, multifamily has no rent restrictions. So you can raise rents, you can evict tenants way easier. You have like, the world's your oyster. And so it's a totally different market than say here. So it's hard to say there's a sweet spot, but in terms of like getting started, I think starting with a smaller building is easier to wrap your head around. I think it's easier to buy a duplex or a triplex or a fourplex or a fiveplex. At 4 to 6 is like where it starts to get into commercial. They do residential mortgages up until 6 units. Above 6 units, it's all commercial mortgages. Once you start growing, commercial mortgages are the only mortgages that make sense because the effort required to get financing is a lot of paperwork. And with large buildings, there's a lot less paperwork. It's the chance of approval is way higher, is what I mean. Like with a residential building, I'll apply to 3 different lenders. 2 will say no, 1 will finally finance it. Then the other 2 will be like, oh, you have too many properties. Oh, we can't do this, we can't do that. Commercial lending, does the property create cash flow? Is it cash flow positive? Yes, we'll lend on it. They look less at the individual and more at the building. So commercial is nice for that reason. When I say commercial, I mean anything bigger than 6 units. It could be commercial office, it could be retail, it could be just residential 10plex with 10 residential units in it. So my recommendation is to start small, wet your feet, dip your beak in the waters of real estate, see if you like it, go through some of the struggles and the challenges. I think the money is well worth the extra stress and struggle that comes with it. But if you want to get to a point where it's completely passive, you've got to buy big buildings. You got to buy a big portfolio. Small portfolios are not very passive. It's hard to outsource everything from bookkeeping to property management when you're a small portfolio. When you're a big portfolio, you could hire your own in-house full-time property manager and you can sort of nurture the relationship and teach them and train them to do things just the way you want it to be, and it can be done well at cost and at scale. So getting to scale is the best place to be. I have no idea about that, Raz, about whether you can stream to TV, YouTube. I don't know. Maybe it could be because I'm in the vertical instead of the horizontal mode. I have the phone set in vertical mode. It's a new feature. That could be why. It's designed for the phone. I'll try and do it horizontal next week for you. Varun says 10-year, 3-year yield curve still inverted along with leading economic indices, LEI, recession still in the works for 2024. Varun, I think that there's a challenge right now when we talk about recession. Recessions are, scary times, right? It's when the economy, by definition, contracts, when we see GDP contracting. The problem is we're going through an AI boom right now where the magnificent 7 biggest companies in the United States are producing way more profit and way more cash flow than they ever have before. While at the same time, the consumer, the average Joe, is maxed out on their credit cards, up to debt, up to their eyeballs, is working 2 and 3 jobs just to survive. There's a big difference, and I think disconnect in inequality right now, where the bottom half of society is really struggling and the top 10% are flourishing, richer than they've ever been. The wealthy who have lots of money to invest in asset classes, they bought Bitcoin that's doubled recently. They bought Nvidia shares that are up 700% in like 2 years. So the wealthy are wealthier than ever. And inflation is just inflating their assets. And the people who don't have any assets are on fixed income, or the people who are on salaries basically fixed income, are struggling as inflation for the last 3 years has run between 5 and 10%. We've had like almost 20% inflation over 3 years. That's wild. Like if you made 100 grand a year, you need to make 120 now from 2021 to now to be at the exact same place you were before, because inflation has made the cost of all your goods way more expensive. You go to the store now, your food, whatever you're buying is way more expensive than what it was 3 years ago. So that's a challenge, I think. To get back to your question about a recession, I think some of the data we know is that the average credit card debt per consumer is at an all-time high, growing at around 20% annual rate, which is the cost of the credit card interest on that debt, which tells me they're not paying it down at all. So eventually that comes to a head, right? Eventually the consumer is exhausted. Right now they've been buying things on credit and they continue to buy things. At what point do they stop buying? Now, right now, earnings in all these companies are really great. Everyone's earnings keep exceeding expectations. Walmart just crushed earnings. Look at all these companies; they're all just blowing earnings out of the water, and that's because inflation. The cost of everything is increasing like crazy, and if you inflation adjust earnings, they're not that good. So that's something that I don't know isn't talked about, I guess, enough, because real inflation is much higher than what's being reported. If you go and check prices yourself, they're manipulating the basket of goods to make it look better than it is. Like, oh, look, like 50-inch TVs are way cheaper now. They were $500 for a TV, now it's $250. Like, look how cheap the TVs are. And that sector is dragging down price. Where you look at rent, and rent has doubled in 5 years on average in my market. That's huge. People spend 50% of their income on housing. That should be weighted in the basket at 50%. People spend, and then the things like the cost of travel has gone down because no one's traveling. It's like, why is that weighted heavily as it is? I don't know. Anyway, I'm not gonna get into that, but Ben Fitness Studio says, do you have any places you want to travel to? We just took the kids to Disney and it was 10 out of 10. We love Disney. We try to go every year to Disney, and we're going to Florida next week. So I might take a day or two and just whip over to Disney at some point in the next couple of months. In terms of travel, we went to Bahamas a little bit ago and we really enjoyed that. It was great. Went to an all-inclusive resort and I want to go back there again. Costa Rica is on the list of things I would love to do. That would be something that's really fun. I just want to spend time with the kids while they're young and enjoy time with them. So one of the things I do want to do is that, is go to Costa Rica, Bahamas. Disney's always fun for sure. We try to spend I think our winters somewhere warm is nice. Come summertime, there's nowhere I'd rather be than at my cottage on the lake, at Lake Huron, from like June, July, August, just being on the water. So nice. The challenge is, or the conflict, I guess, in my mind is like that cottage rents for $1,000 a night on Airbnb during peak season. So I have to like accept that I'm losing $1,000 in potential revenue to pay all our bills on that cottage. So it's a challenge. But yeah, in terms of just like if money was not a thing, I would just live on the water all year round. I'd be in the ocean. I'd be at the ocean in Florida or somewhere, Bahamas in the winters. And in the summers, I'd be here in Canada on the lake where it's nice and warm and sunny. I just want to chase the weather. So as the weather gets cold here, I want to go somewhere warm. And then as hurricane season and whatever happens there, I want to come back here and enjoy the beautiful Lake Huron, sandy beaches and fresh waters. Raz says, can rates go so high or many start losing their homes? Or does the government always step in and bail out the mortgage lenders or banks if it gets too bad? So to answer your question, we've never seen it where the bank didn't step in. Where the government didn't step in to bail out the banks. So the government will step in to bail out the banks. They always have, they always will. It's in their best interest to do so. You got to remember that the government is just the collective of the people, right? It's the will of the people. And what do people want? They want stability. They don't want to see people looting and rioting in the streets. They want calm and stability. So if the nice thing for the banks and the risk takers is if they take an exorbitant amount of risk and swing for the fences and they miss, the government bails them out. If they succeed, they swing for the fences and they win. So they have a backstop of the government to protect them. So it leads people in the banking industry and the financial industry to take lots of risk, to make lots of really risky bets. And that's a problem, I think, just a systemic problem that exists because there is always a bailout. But yes, if things get bad enough, there's always a bailout. Things aren't that bad, I guess. Like you look at some of the data, people are okay. They're managing. Less so in Canada, but in the US, like a lot of people own their houses mostly in cash. And so people just find a way, they invite family members, they rent out spaces, they find a way to make their payments. But yes, people are struggling more now than before. And I think rates do need to fall. It's interesting that the market sentiment was like, for sure, rates were going to fall. And now it's getting to the point where like, they're saying maybe rates are going to stay higher for longer. And like, maybe we're looking at the fall now for a cut. I don't know. Are they just trying to create, belief in that fact? Yeah. Someone asked another good question. I'll raise it. It's about family. Benefitness Studio said, as a parent of one of my greatest fears is spoiling my kids. You grew up with a chip on your shoulder. How are you going to foster that in your own kids to not create your kids to be spoiled? Well, I think one of the most important things is I want to give my kids opportunity. I want to give them opportunities that I didn't have as a kid. But at the same time, I think it's important for kids to learn. I think it's important for kids to learn that they need to work for the things that they have. And it's really important that kids understand, that things aren't given to them, that they have to earn it. They have to see that through hard work, that's how you get the result that you want. And so I think a lot of it comes down to like incentivizing the right things. And by that, I mean like I need to be dangling the carrot and the reward. So if you do your chores, you get X reward. If you do this, then you get that. And so it's important, I think, not to give your kids, hey, we're going to Disney. It's like, instead of saying, hey, we're going to Disney, how can we go to Disney? You guys want to go to Disney? Yeah, I want to go to Disney. Well, what can we do to earn that? And everything has to be earned in life. It's not given, it's earned. And so that's a big piece, is like trying to teach my kids that they need to work for the things that they have, and that through hard work, once you do the hard part, That's when you get the reward. The reward doesn't come before the hard part. And so that's been a lot of it, is like just teaching my kids that that's how I live my life. Like I have to work for everything that I have. I came from nothing, and everything that we have today, the success that I have, why you guys watch me on here, is because I worked really hard. And so I continue to teach my kids that exact point, is that like I work really hard, and that's how I have what we have, right? My wife and I work really hard, and we try to lead by example too, right? Like that's part of why I work even today, is like I want to show them that I'm working on my phone, negotiating deals and trying to lock up properties and working with clients to do things and negotiating on the phone with different things. It's like I want to show them that I'm working in business. And then in business, money doesn't just come for free. You have to work at it. And through that example, I hope that they'll also have success, and they'll have an even better life than I had, because they learned from where I failed and where I succeeded too. Port City Investments, thank you for the super chat. Really appreciate it. He says, hey, Mike, cash flow negative on 2 properties. Sorry to hear that. The question is, I guess, how do you maybe find a way to eke out some more profit out of the property, increase, revenue? Port City says, rents are about $500 under market value as is. Can only raise rents $100 a year. Would take 5 years to get to market. What do I do? I'm wrecked. Whew, that's a tough situation. You've got to find a way to get the rents up. That's the most important thing, is like finding a way to drive revenue. So can you build an accessory dwelling unit in the backyard? Can you convert a garage and rent a garage out? Can you build a garage and rent that garage out? Could you build a shed, rent the shed out for $150 a month? Is there something you could do to increase income? Maybe you could pay the tenants to leave. There's lots you can do, right? Let's see. Only raise rents $100 a year, but you could talk to the tenant, right? You could renovate the unit. There's things you could do. Maybe the tenant would agree to an increase in rent. So there might be a way to get the tenant out, or to get things up, to get into cash flow positive situations. Yeah, I did. Of course. My parents were separated. I lived with my dad for 6 months. I lived with my mom for several years. When I was 11 or 12, I moved in with my biological mom and lived with her, and she's my mom, and I appreciate everything she does for me now and did for me then. She struggled. She has her own, trauma and struggles, and I didn't come from a normal household. She did okay. She had a full-time job. She made minimum wage. So we were, my brother and I were living in a single parent household for that period. At 16, I got my own car. I was just working all the time, full-time, trying to save to go to university to move out. At 17, I was gone. I left, and that was it. So that was the way I did it. I didn't go back in the summers and live at home. I just didn't have a good home life. There was struggles, and I don't blame my mom. She had her own struggles and stuff too. And when she lost custody of us to her ex-boyfriend for a while, which was my foster dad, not my biological dad. Anyway, it life happens as it is, as it happens, and you learn from it and you improve and you get stronger. A lot of people go through trauma and they just give up and they shut down. And it's like, you got to look through going through those traumas and find ways to improve yourself, right? And there's no point in wallowing. What's happened has happened, right? Like I could be depressed right now and crying that I lost $50,000 on Nvidia, but it's like, what good is that going to do? How does that help? For a little while, I might flog myself. Like I might go out tonight and flog myself a little bit. Like I made this really stupid decision. It's like, what'd you learn from that? Well, okay, like don't make a stupid decision like that again. If you can't handle that amount of risk, don't get into those types of risky situations. And we do this to ourselves all the time as humans. Like we have a risk profile and then we don't honor it. It's that's just being human. We make mistakes all the time. It's just the nature of why we need trading plans and why we need to set rules for ourselves and boundaries, because we're horrible at honoring our boundaries. The brain is like really good at saying like, we know we need to go to bed early, but we push ourselves. It's like, why? Like the brain sometimes shouldn't be listened to. It makes bad decisions. So it's important, I think, to set rules and boundaries and think thoughtfully about how you're going to help your brain to make the right decisions the next time. And it's about little tricks that you can do to keep yourself on the straight and narrow, on the path of success. No problem. Thanks, Vern. Thanks for the comments. Costa Rica is gorgeous, Viv says. Stayed in La Fortuna and Puerto Viejo. Go if you ever get the chance, but don't stay at a resort. Look into private house rentals. Interesting. Definitely on the bucket list of things I need to do. Alex says, what skills have been most beneficial for you in real estate? I think every real estate investor harnesses some slightly different, strengths or skill sets. I would say for me, it's negotiation has been the number one. Like I'm a good negotiator, and I'm persistent and stubborn. And that stubbornness has served me really well in business. I'm good at negotiating the supply costs. I'm good at finding deals on things, and I will look high and low to find that deal. I'm good at negotiating higher than market rents in some cases, or negotiating with tenants. If I have to get them out, I'm good at negotiating. So interpersonal and negotiation skills, super, super important. Cost control, super, super important. Looking and design. I've been really good at like conceptualizing what something will look like before it actually happens. So I can walk into a space and be like, this 2-bedroom house can be a 4-bedroom house. That was a skill. Like I was just able to see how that can be divided into 2 units instantly. That was just a thing. Like I walk in a house and I instantly see its best use. That's partly from training. I've practiced through hundreds and hundreds of renovations, literally hundreds and hundreds of renovations. I've learned that. It's a learned skill, right? And I optimize it for cash flow, right? So that was something else, I think. The other thing is I'm good at learning from other people. They say emulation is the sincerest form of flattery, I guess. But like I was looking at what people are doing who are succeeding, and I'm like, well, how do I copy and emulate what they're doing? I'm really good at that. I'm good at like cloning what works. I'm not necessarily unique or special. I'm just good at finding what works and doing that as well, but sometimes even a little bit better. That's it. That's pretty much it as far as like skills for real estate that I can think of off the top of my head. But yeah, it's just a business like any other. Hard work, determination. If you put in the time, you get the result. If you ignore your tenants, you don't respond, you're the kind of person who just shuts down when there's a problem, real estate is probably not for you. You need to bring someone in for property management or something if that's you. There's a way to do it, but you have to change the way you operate your business to work with your strengths and weaknesses. David, how you doing? Says shout out. Raz says, do your kids know of wealth or richness? Would you tell them? Would you buy them a car when they're 16? So Raz, it depends, I think. I think my kids do know to an extent that I have worked very hard and that I'm really successful. Like I am one of the most successful in our town. I'm one of the most successful people for my age. And in real estate, I'm one of the leaders, right? I'm one of the thought leaders. So, I mean, of course, they obviously know that. They know that I do the show, and they know that people follow me and learn from me, and that I share content. I'm a teacher and educator. They know that stuff, right? But I would definitely say that it comes down to like, they're not rich, I've had success. They're not successful, I'm successful. And they haven't earned it yet. I hope that they do. Like my greatest hope is that my kids are a chip off the old block, so to speak, and that they want to join the business and they want to be part of what I'm doing. Because I would love, like the whole reason I started this whole business and worked so hard was to build something that they can take further. I started the company, but they're going to take the company to the next level. So my hope is that they can grow it to levels I never could with my help. I hope I can work with them, right? Train them and teach them what I know and help them, grow. So my hope is that they will work and take us to be a billionaire family, a very successful. I have this fantasy of us building this massive business together, where we have this awesome compound, this family compound of like properties, like our own little town. And so there's a lot of cool things I think that could happen. I hope that my kids are financially motivated and that they do put in the work, because it's not easy. But I think that together as a family, we can do a lot more than I could do by myself. So as a team, like it's family money, you know what I mean? If we all work together, I want them to have access to that pot. Would I just buy them a car? Probably not, no. I'd want my daughters to earn a car. And at 16, I would happily get them a car, but we'd make a deal. They'd have to work for it. They'd have to pay it off. Of course, we'd make a financial, I guess, agreement of sorts. Kai says, what is the best source for private financing? Best source of private financing, like individuals, I would say, like going to like a flip individual or a small corporation that is like a MIC, mortgage investment corporation, that just like focuses specifically on flips is great. Banks don't like you to flip. If you flip their products, you'll find that they'll cut you off of lending pretty quick. So you want to use, if you're going to flip, get a short-term, high interest rate, open mortgage, and then refinance it into the bank mortgage if you're going to keep the property. But start with a private mortgage and then refinance them out. That's the better way to do it, I think. But it depends. I've done it both ways. My first 10 properties, I did it all with A-lender banks. And I just held them, refinanced them, bought another one. So you can do it with A-lender financing to begin with, but if you tell them you're going to be flipping, you got to be careful. So I would say go to the banks. I like Scotiabank. They were great to work with. Bank of Montreal was also very good to work with. I had some mortgages with CIBC for a bit there. I had one with TD. TD was hard to work with. I didn't like them. RBC, I did not like RBC at all. Just didn't jive with that bank. Boom, boom. Philip says, as you know, mortgages in Canada are generally 5-year terms. That's true. They're 5-year fixed rate terms, then you renegotiate the rate again on a 25-year amortization. If a value real estate investor, one that optimizes for cash flow, has to renew and is now cash flow negative, should they sell? It depends. Maybe. If they're going to sell, wait for the spring, wait for the peak, wait for rates to start to fall, I think. Most mortgages renewed in 2020, 2021, 2022, they're starting to renew soon, right? People did 2-year, 3-year fixed rate mortgages. Half of people did variable rate mortgages. Thereabouts, 25% of all mortgages left are still at the old rates. So meaning 25% or half of the fixed rate mortgages have already renewed into these new higher rates in 2022, 2023, and 2024. We've had 3 years now, and they typically are on a scaling 20% a year renewal cycle, a little bit more than that because there's 2- and 3-year and 1-year fixed rate mortgages, et cetera, so forth. My point is to say that 3/4 of mortgages have already renewed into this new interest rate environment between 4.5%, we'll call it, and 7% right now. So that's just the nature of where it is. But as rates fall, people can afford a lot more. So I would try to wait if you can, if you think that rates are going to fall, which I do. I've been holding till the spring on a couple of flips. I'm going to sell. I'm waiting because I'm not getting the price that I want. I'm going to wait a couple of months. But in the spring, whatever I can get for it, I'm going to dump it. Now, if you have a cash flow positive property, and you asked about cash flow negative, but if you have cash flow positive, definitely hold it. If it's negative, maybe $100 or $200 a month, who cares? You can hold it another year to the spring of 2025 as rates start to fall, probably get a great exit. I would say, I would definitely say that there's potential there for a more appreciation in the cash flow loss. So if you're losing $200 a month of cash flow for a year, you're talking about $2,400. But maybe you're going to get appreciation on that house of $20,000 between now and then, because as interest rates fall, real estate prices are going to rip up. That's just the nature of how it will be. It's just a fact. As rates rise, house prices fall. As rates fall, house prices rise. Just basic math. Raz says, why do you prefer to be an investor versus a realtor? Do you not enjoy being a realtor exclusively, or was it not for you? Raz, I am a realtor. I'm a licensed realtor. I can buy and sell real estate. We have our own brokerage, Investors Choice Realty, here in London. That's what we specialize in, is investment properties in Southwestern Ontario. So I don't promote it because, again, I'm not actively looking for clients, but we do take clients on occasionally. I do help with that. So I'll just throw that out there. I've been a realtor for many years. I didn't start as a realtor. I started as an investor. So in terms of what was a good fit, I just don't enjoy selling granny's house at an open house with cookies. I've always been an investor-focused realtor. So that's just been my style. But being a realtor can be very fruitful. I know lots of realtors that make $1 million a year in commissions. I mean, it can be very profitable. It just wasn't for me. I just didn't want to be servicing clients in that way, so to speak. I just didn't enjoy it. All the paperwork that went along with it. It is a great business. I just prefer the real estate investor side. But yeah, realtors can make great money. Some realtors make more than flippers, make more than the real estate investors themselves. So it just depends on your fit. But for me, I didn't want a job. I was looking for passive income. It's hard to build a real estate brokerage where it's completely passive. Whereas it's easy to buy a bunch of properties and put a property manager in. And then once it's stabilized, it's very passive. So I liked that I could make things, I've always wanted to make things passive eventually. I get bored of things quick. And so if I can't stabilize a property and make it passive, I'm going to sell it off. I often sell properties that aren't a good fit for my portfolio. It's just how I am. I want the end state to be stabilized. Kai says, thanks, Mike. I like my Scotiabank mortgages too. They're great. Scotia's been really easy to work with over the years. Less so recently. I haven't been working with them at all recently, but in my growth phase, I had tons of mortgages with them, probably 15 or 20 mortgages I've done with Scotiabank over the years. So they're great things to say about them. Recently, I currently have no mortgages with Scotiabank. So my mortgages now are with Bank of Montreal. They won my business over, gave me better rates, and set up some really cool private banking stuff where they courier drafts for me to the lawyer. I have the best private banking service around. I email or call my rep and they do everything. I don't even go to a bank branch anymore. It's all done at the private banking level and it's fantastic. I have an amazing program with them. they've won me over because they made my life so easy. I'm able to do business now from my phone, from anywhere. I can be in Florida and funding mortgages. They're running bank drafts from Bank of Montreal over to my lawyers. It's great. Out of country, I can run all my banking. So I really like what Bank of Montreal has done for me on the private banking side. Only good things to say. They've given me great lending facilities, at great rates, like prime interest rate. I can't complain at all. They're a great bank. Scotia just didn't play ball as much. William says, Mike, CVNA earnings out tomorrow afternoon. Any thoughts? Thanks. Full disclosure, I'm short CVNA. I have a short position on that company. I think they're a trash company. I think they're $20 a share maximum, and they're trading like $50 a share. So in the long game, I totally think the company's gonna decrease 20 to 30 to 40% from where they currently are. They're overvalued. Do I know what's going to do tomorrow? I have no idea. It's a coin toss. What you should do is hedge. So what I should do, I haven't been watching that their earnings is tomorrow. I should know this, that their earnings are tomorrow. And I should probably hedge for that event and then take the hedge off after earnings come out. Because my long position on them is that they're going to go down in value. They're a really crappy company. Raz says, what do you think of the ongoing commission lawsuit taking place in Canada? I haven't been following it a ton, but I know the sentiment in the market is that people think realtors are overpaid. I tend to agree in a lot of transactions. Overpaid is relative to value provided. So do I think a lot of realtors don't provide good value? Yes. There are some, though, that provide great value. And those ones that do provide great value, they're worth every dollar. I had a realtor once sell a house for 20% above market value. I feel bad for the buyer that they double-ended the transaction. And I feel horrible for the buyer that bought the property, but I got to sell my property for a huge premium. They were a great realtor, and they charged me, I think, 7% commission. No, might have been 8% commission on the sale of the house. They came to me and said, hey, it's 8% commission. That was a lot, 8% of the entire sale price of this property. It was like their commission was almost as much as I made on the entire property on my whole, after renovations and everything. They were making the same net profit. But they were able to convince their client to overpay for it. That's a conflict of interest. I don't want to get into the ethics on that, but some realtors have great connections to overseas buyers and things. And so sometimes realtors have great relationships and they are worth every dollar. Especially if out of that some realtors will go in and they'll paint your house for you. They'll stage the whole house, buy furniture for the whole house, spend $10,000 on furniture and make the house really nice. And then they'll get professional photography and they'll do all the work to sell the house for the max dollars. And in those cases, they might be worth their every dollar. But if there's some realtor comes in, takes some photos and throws the listing up, and doesn't try very hard, doesn't sell it for much, they might be overcharging you. So I would say it's based on value. To explain, sometimes you pay for something and you get more. Sometimes you hire a contractor for $20 an hour and they're worth less than $0 an hour. And sometimes you pay a contractor $50 an hour and they produce so much in value to get the job done twice as fast. One guy at $20 an hour takes a week to do that project. And another guy at $50 an hour takes a day to do the same project, or maybe a day and a half. And it's like you actually paid less to the guy $50 an hour. And the carrying cost of that 5 days of savings, or could be a month in some cases on some flips and projects, the carrying cost of that, the mortgage, the insurance, the utilities, all the costs of owning that home for that time that it was not rented out. Those are big savings that you can pass on to the contractor who's fast and good. So speed is everything, I think, in the business. Did you do a BRRRR on your first investment property? No, I did not. My first property, I pretty much lost money. I broke even on my first property ever. On my second property ever, I made lots of money, but it wasn't a full BRRRR. My third one, it was a full BRRRR. Fourth one was a full BRRRR, fifth full BRRRR, et cetera, so forth. I learned the buy. The BRRRR is the buy. You renovate the property, then you re-rent it out, then you refinance it and pull the equity out that you put in. You get all your refinance, all your injected capital, so your down payment and your renovations and your carry cost back out of the project to go buy another property. And you still have the property left over. The underlying assumptions that the property's gone up enough in value that the new reappraised value allows you to pull out all the money you put into it through a refinance. The bank lends fresh capital on that property and you can pull that capital out, pull that money you put into it out because you've increased the value so much on the property that this new increased equity stays with the property as your down payment. So your original down payment you can pull out and use that capital to buy something else. So that's the thesis behind it. It's a fantastic way to invest. If you do BRRRR cash flow type properties, it's hard to lose. So yeah. Can you negotiate the amount of commission to the realtor depending on the amount of the house gets sold? 100%. I always negotiate. In some cases, I've had people list my properties for 0.5%. They co-list with me, and I pay them 0.5% in some cases. I've had people, I had someone list a house for 0% for me because she wanted the leads. She's like, I'll list your house for free, but if I sell it, or any leads that come out of this, when the phone rings, they're mine. I was like, 100%. Anyone who calls you to buy a house with you, 100%. And if you bring the buyer to me, I'll pay you 2.5% commission because you're doubling the transaction. So definitely having the listing is, in this kind of market, can drive a lot of buyers to you. So some people will list for free. Some agents will do it for nothing because they can get buyers from it. They're looking for clients, right? It's a sign on the lawn, it's reputation, it's, you know what I mean? So there's tangent benefits that come from it. So 100%, you can definitely negotiate, but know when to do it. Sometimes it'll kill your deal. So just know when to do it. But yes, you can definitely negotiate, especially if you're bringing like multiple listings to them. I would definitely ask them for a discount for sure. All right, that's all the questions. Looks like we had a good week. Thanks everyone so much for tuning in. Remember, the secret to unlocking a wealthier you, there's 3 levers and control your financial future. This is how you do it. You spend less than you earn more, find strategies to earn more money, and then the difference between those, when you're earning, what you're spending, is your savings. And whatever you save, maximizing returns on those savings is how you grow your wealth, how you unlock financial independence and live the life that you want to live. You don't have to work ever again. That's the secret. Spend less, earn more, maximize returns. All right, guys, see you next week. Thanks for tuning in.